What's good everyone, it's your boy Archer, and in today's video tutorial I'm going to talk about how I personally use the exponential moving averages, also known as the EMAs, to take on my daily trades. Once again guys, welcome to my YouTube channel. Today's video tutorial is going to be really interesting. I took some time to do this just so that I can make sure as a beginner you understand every single thing I am explaining today. This strategy is really a simple strategy to adopt as a beginner and will really help you develop yourself as a trader in the long term. And why am I so positive about this? I'm positive about this because with the EMAs you can actually trade scalping, which is very short term. You can do intraday trading, which is usually within a day, and swing trading, which could last you 2 to 3 days, even more. You could even use it for position trading. However, it's really long term and to be honest, it's boring, right? So let's start. What are the EMAs? Okay, they are called exponential moving average. They basically take weighted average of price movement over a certain period of time. Okay, so what EMAs do I use? The number one EMA I use is 800 EMA, labeled in dark blue. Second one is 200 EMA, labeled in white. Third one is 50 EMA, labeled in aqua, and this EMA tells me strong psychological levels. The 13 EMA is red, and the 5 EMA is yellow. Now, the larger the number of the EMA, the slower the EMA would be. So 5 EMA would be faster than the 13, and the 13 would be faster than the 50, and so on. Okay, so how do I use these EMAs? First of all, I'm going to bring out my EMAs and show you exactly what I'm talking about. As you can see, they're clearly labeled here, just like in my description over here. So how do I trade the EMAs exactly? I have two types of trading style. Number one is with a trending market. A trending market looks exactly like this, where price is moving in a particular direction. All right, and then in a retracing market is where price is pulling back for a correction this way. All right, now some key things you need to take note of. A trending market is usually low risk and high profit and usually lasts longer term. Why? Because imagine you in this trend, there are chances that it would trend for a longer period of time compared to these tiny corrections that usually don't last against the larger trend. And like I said, the retracing market is usually short term and it's high risk and low profit, to be honest. Okay, so you don't really, because you can't really hold them for long, they're high risk simply because they can always push back to where the initial trend is. So what does a market cycle look like? I've drawn a diagram here. A market cycle in a trending market, of course, would be a push to the downside and then a retracement for correction of the impulse push, and then you have another downward push. Usually this is called the third wave in the Elliott theory. I don't want to complicate it for now. You have a push down and then you have another correction and then you have another final push to the downside. Okay, so if I'm going to explain this again, you would want to be in this situation over here where you are trending with the larger trend. It's called trend trading. All right, and another famous quote is the trend is your friend, simply because the chances of you going wrong is way slimmer than you trading a correction. Now, what is a correction? Correction is the same thing as retracing. This is a correction. I'm going to label this in a different color so we don't confuse things. All right, so let's give this a pink. Right, so these are corrections, correcting the larger trend. Okay, so a retracing market would be you trading somewhere here, usually very high risk. I would only advise as an advanced trader you get in if you know exactly what you're doing. Now, trading a retracement isn't necessarily high risk if you're trading larger time frame, but if you're trading smaller time frames like 15 minute or 30 minute or 5 minute, it could get really risky because markets are very volatile. And then this year again is also a correction. So how exactly do I use the EMAs to trade? Like I said, I'm going to zoom in. The first thing I'm going to do is explain what these moving averages are about. The 5 EMA tells me the psychological level. If I'm in the 1 hour chart, it tells me in the last five candles to the past, this is my current average price. Okay, similarly for the 13, right, it tells me in the last 13 candles where the red is here is the average of the price from the previous 13 candles, or price closing and opening. 50, like I said, is a really strong psychological level. Tells me what is my average price within the last 50 printed prices. And why is 50 so important to us? It's simply because 50 is a psychological level between buyers and sellers. Price above 50 tells me that this is in a buy-buyers market, and price below 50 tells me that this is in a sell-buyers market. Doesn't mean we should buy, neither does it mean you should sell. It just tells you where you are in price. So if prices is above your 50 moving average, it's simply telling you to look for buy opportunities, okay? And if prices is below your 50 moving average, it tells you to look for selling opportunities. All right, my 200 EMA also tells me price within the last 200, average price within the last 200 candles, and 800 tells me price within the last 800 candles. And what are these? These are really your support and resistances in the market. Okay, so what you want to do is look for where price is trending above these 5 lines, and you get a good opportunity to go in for a buy if you're if you're looking at an uptrend. Similarly, if you're looking at a downtrend, you want to find favorable conditions, such as here, where you have all your 5 moving averages above price. Clear so far? So how will I trade this? So another important thing I would like to discuss today is your support and resistance level. Really key to know what is your support and resistance level. I'm going to take out my moving averages, and we're just going to have a simple example of what I mean by support and resistance level. Okay, so right here you have price moving in consolidation, right? This was retracing. This was an impulsive move to the upside, and then market is now in a corrective phase. Usually looks like this. Price doesn't really move anywhere, to be honest. Okay, so this would be somewhere here or here, and this would be somewhere here or here, depending on the market or the tool you're looking at, the chart you're looking at. All right, so how do I trade this? Basically, if I drew out this level, okay, as an area of consolidation, what I'm looking for, right, is a breakout of this box to the upside. Okay, and I'm sure you've heard this severally. We always wait for price to come back and retest where it broke to confirm the uptrend. Okay, so in this case, I'm gonna bring out a pattern line over here. So in this case, price was ranging or consolidating in this level over here. It broke the box, moved all the way up, and now it's back to retest that zone again. Okay, so if it retests this zone, what we're looking for are clear confirmations to go in for a buy, hopefully for another push to this direction. Okay, if price fails to do so, okay, moves up, comes back down, retests, and then for some reason comes back into this box and start ranging again, what we do is we wait for clear movement to a specific direction. Okay, so how do I use my EMAs to trade this? It's simple. Now, ordinary or a lot of traders trade price action, right? So they don't need the moving averages, right? And why I believe this is really important is because this market is all about price action, to be honest. However, with the moving average, it also gives you more confluences to be able to be more confident when you're taking on the trade. All right. So an ordinary price action trader would confirm this as a retest, and of course would go in as soon as they see this bullish engulfing over here. And this is for much more experienced traders. You also have another scenario here. You have a small break and then a retest and another bullish engulfing over here, if you can see this. Okay. But with my moving averages, where would I get into the market? Personally, I would get into the market over here. Okay. But how would I confirm this even more? I take out my moving averages. Right? Now you can see perfectly the price broke. Price was trending above the 50 moving average and now broke the 50 moving average and came back to this area of support. Now if you take note, you see that your 200 moving average is the support of this previous breakout. Okay? So this was, like I said, a first confirmation to enter this trade. But because I strongly believe in the 50 psychological level, I would wait for a break above the 50 psychological level and a confirmation. And simply because it broke above the 50, it now tells me, okay, fine. Number one, I have all my 5 moving averages above price. Okay? I have all my 5 moving averages above price. And now all I have to do is wait for price to give me a more confident reason to enter. And right here you could see a lot of movement and you have the bullish engulfing over here. What I mean by a bullish engulfing is you have your bull candle closing stronger than your bear candle over here, and you would go in for a buy. Okay, if we're gonna dive into more details, all right, I would bring out my tool over here, and say you got into the market somewhere here, you can put your stop just somewhere below here, and you target your next area of resistance. Okay, so you can see with this move over here, if I'm taking only this trade, I am having a risk to reward of 3.85. Amazing risk to reward. Okay, you could zoom out and look for higher, okay, level of resistance somewhere in the past. However, if I'm trading short term, you would just take your previous level of resistance, and you can see that this is almost 3.8. Beautiful risk to reward, and you can see immediately we confirm this, the market shot up to our direction. Why? Because we are in an overall trending market. Okay, so that is one example. Let me look for another simple example. I'm going to take out my moving averages. Okay guys, so let's take a look at this bearish trend. Okay, I'm going to make this more interesting. All right, so you have this market over here moving in a downward cycle, right? This moved into a bearish trend, okay? And then you have a correction that came this way, okay? Remember, our correction is the same thing. So this market basically corrected to the upside. Let me just pick up my trend line, okay? And correct it this way, all right? Okay, so this is a pattern called a rising wedge, just so you know. So how would I trade this basically? Now, because I know the market was trending down to the downside, I would look for an impulse, right? A correction, and then a continuation to the downside. All right, just like you're seeing over here, you have the impulse here, the correction here, and then continuation to the downside. All right, so how would I trade this? How would we trade this? We would wait for the break of this channel, okay, and once it broke this channel, it created a new support along this area here. Okay, now just to be safe, what should we do? Basically, we wait for price to break this level of support and then come back to retest and make this our resistance, our new resistance. So this was a previous area of support. It broke this previous area of support and then became resistance. So how do I trade this basically? Okay, we wait for price action over here, and for experienced traders we can already see reasons to enter this market right here. Okay, but I'm going to pull out my moving averages just to tell me where exactly price is. Now you can see beautifully, right, that once price broke here, it came below the 50 moving average, which is my psychological level, came back to retest, and then gave us a bullish engulfing exactly on this area of support and exactly on this 50 moving average. Entry would be exactly here. Okay, and if we pull out our risk to reward once again, you could see that we'll put your stop just above this previous high, and then we target lows, right? We target these lows over here, right? And you can see this is a risk to reward of 1:4.4. Amazing risk to reward. And you can see that the market really pushed down and never came back up to this level again until it got to our target price. Now, I hope you found this video tutorial really useful, guys. Once again, thank you for all the support. Our subscribers are growing daily. Thank you very much. Please click on the like button if you enjoyed this video. And for more updated videos from Archer, please click on the subscribe button, and we appreciate your support. Once again, it's your boy Archer, and see you in my next video tutorial. Peace.